Welcome to your Mortgage Insider Update, March the 9th. Well, it's been a volatile few weeks. Over the last 4 weeks, we've seen interest rates fall significantly and come back up relatively significantly, about half as much as we had previously seen following the 10-year Treasury. This as oil prices are spiking over $100 a barrel to begin this week off, as we're about 10 days into the conflict in the Middle East, cutting off the Strait of Hormuz. Causing a lot of fear around inflation. One thing about fear is that it comes in waves and oftentimes overcorrects. So we might be seeing a little bit of an overcorrection and a little settling in the interest rate market while we see things play out on the world stage. So let's take a look and see where the bond market sits today. As we usually do, we follow the 10-year Treasury as the general barometer on the worldwide interest rates, the biggest bond market in the world. The 10-year Treasury reflects generally the direction of long-term interest rates, such as mortgage bonds. So we'll stay close to the 10-year right now. And we can see we've come off some of the highs on Friday. Large moves in the bond market, both high and low, ended the day relatively calm. Today, starting off high again, after oil started the week off at over $100 a barrel, settling down a little bit, and just a little perspective on where we've seen interest rates move. If we go back about 3 weeks, we saw February 12th, where we had a pretty steady move lower. We're not anywhere near the highs we were back in the late part of January. So overall, bonds have calmed down, but definitely come off the lows of March 2nd. Or I guess February 27th, the Friday before the conflict started in the Middle East. We saw the big move higher, and it continued up through the end of last week. We can only hope that this week will bring some stability to the bond market as things start to play out. For a quick look at the mortgage bond picture, now the mortgage bonds price will go higher as interest rates come down. So today we see the 10-year Treasury down 1 basis point. The mortgage-backed security price is 7 basis points higher. As we focus on that chart, just keep in mind this is the inverse of the actual move on interest rates. As the interest rate to the consumer, again, is the end user, the bond purchasers are the folks investing in the bonds. So we've seen after multiple red days, that's last Monday, where the prices fell, interest rates were going up, and they fell each day last week, finding a floor right now that takes us back to the floor and the level back at the beginning of January. So we saw prices moving up at the beginning of the year, interest rates were coming down. This was right after the Trump administration announced that Fannie Mae and Freddie Mac were going to buy more mortgages. That settled down a little bit over the last part of January and stayed pretty steady. We saw the prices go higher, again, lower interest rates back in the middle of February. And it stayed there. And we were just testing this high that had been in place for basically about 3 years as the high point in the mortgage bond prices. Interest rates hit that low point, and Fannie Mae, or Freddie Mac, I should say, published their weekly report on a couple Thursdays ago, where we saw rates at 5.99%. Last week, they reported a little bit higher at 6.01. We'll see how this week plays out. I think interest rates in general are moving a little over 6%. Not terrible moves. We haven't seen a huge fallout. Of course, we want to see prices go back up. But if the mortgage bond price were to keep falling, we could see levels that we were dealing with back in December over the holiday season. So hoping for a settling in the bond market. So we'll keep an eye on everything this week, come back every week with an update. Later this week, personal consumption expenditure, the Fed's favorite measure of inflation, will come out on Friday. A couple other reports coming in that will start to potentially let the bond market trade on more of a current news and job reports and inflation reports, which is what typically drives interest rates, as opposed to the world crisis that's going on in the Middle East right now, causing a lot of angst and a lot of concerns over future inflation that will have to play out over the coming weeks. Have a great one.